Right. Good day, everyone, and thank you for joining us for this panel discussion around the very exciting topic of sustainable finance and ESG investing as a way of stimulating economic growth and capital markets, especially now during and post the COVID-19 pandemic. So last year was a landmark year for sustainable finance globally. Social and sustainable bonds beat their previous records for amounts raised, while green bonds hit new highs and sustainable companies issued record levels of equity. Today, we will get insight from our panelists as to what this current landscape looks like globally and obviously for MENA specifically, and then also what we can expect regarding sustainable finance in the future. So I would like to welcome our speakers to today's panel session. We have Daniel Clear, who is the Global Head of Sustainable Finance at HSBC. We have Beatrice Marser, who is the Regional Director for Middle East and North Africa at the International Finance Corporation. And lastly, we have Leon Saunders-Culvert, who is Head of Research and Portfolio Management at Refinitiv, which is now part of the London Stock Exchange Group. So I'm going to ask each of the panelists to quickly introduce themselves and make some opening remarks, and then we will get into our panel discussion followed by Q&A. So please remember to post any questions you might have during the session in your events app or on the website. Right, so with that, let's go into intros. Daniel, I'm going to start with you. Please go ahead.
Thank you, Franita, and good afternoon, everyone from London. I lead sustainable finance at HSBC, as Franita said, and that for us really includes looking at this as a big future business opportunity, because we see that our clients are moving, we see that the industry is moving, and we obviously see that we have to mobilize trillions in the fight of climate change and other social issues. We look at this as a major risk, because we know if we don't address it, we will face balance sheet risk, financial risks, but also further unsettlings in the financial system. But also, I think for us, it is very important that this is a major element of the broader purpose of the financial system. I also lead the Climate Risk Working Group at the Bank of England and the Sustainable Finance Working Group at the IIF, which is the International Banking Associations, and I'm happy to share some insights from that. I hope we will bring across three topics for you in this session today, and that's really sort of my quick opening. First of all, I think you all realize that 2020 was a catalyst for sustainable finance. We've been talking about this for quite some time, but 2020 was the year where everybody realized the power of nature and natural events if they go wrong. A lot of investors realized that ESG is really a driver of performance, not just a reputational item that people have to look out for. And we've seen significant moves from regulators and policymakers in shifting this agenda into the focus. My second point that I hope you will take away from today is we see a lot of positive signs that this is now becoming mainstream, but there are also a number of challenges on the way for this to grow further. And I think that the reason why this is becoming mainstream is that most investors around the world, especially in Western markets, have now started to integrate ESG into the way they look at investment processes. Because as I said before, it becomes clear that ESG is a driver of alpha, not just a good thing to do. But also we see a lot of regulators now pushing for standards and disclosure. But that also brings me to the challenge. The challenge is at the moment that we have too many standards, lack of information, and with that we have lack of trust in the system. And the third point I would like you to take away from today's discussion is that 2021 will be an even bigger year for this. We have the US back on the table with President Biden making this a big topic. We have the discussion about a green recovery and building back better as we come out of COVID. And obviously we have COP26 coming at the end of the year. So if we all think that 2020 was an important year, 2021 will be even bigger. Franita.
Great. Thanks very much, Daniel. Beatrice, I'd like to hand over to you next then.
Well, thank you very much, Franita, and good afternoon, ladies and gentlemen. My name is Beatrice Meiser, and I'm working for the International Finance Corporation as the Regional Director for the Middle East and North Africa region, based here in Cairo in Egypt. The IFC is a member of the World Bank Group, which has two overarching goals, which is ending extreme poverty by 2030 and boosting shared prosperity. In developing countries and emerging markets, IFC seeks to promote economic development, access to finance and employment creation, but also gender equality in business and life, environmental and social sustainability, and climate change adaptation and mitigation. Hence, it is clear that sustainable finance is key to IFC's developmental mission. As the largest global development financial institution focused on private sector development in emerging markets, IFC is uniquely positioned to engage governments, regulators, and market partners to introduce environmental, social, and governance standards. IFC has been at the forefront of standard settings for sustainable finance already back in 2003 with the establishment of the Equator Principles. And IFC also played a principal role in the creation of the Sustainable Banking Network. More recently, IFC has been a major contributor to the development of the Green Bond Principles by the International Capital Markets Association. So these are some initiatives that IFC supports to create the proof of concept to develop new standards and instruments for sustainable finance globally.
Right. Thank you very much, Beatrice. And then lastly, Leon, I'll hand over to you.
Thank you, Franita. So Refinitiv is obviously a very large market data provider and recently acquired by the London Stock Exchange Group, as you rightly pointed out. And of course, as a very large market data provider, one of the things which we think is central, certainly to our purpose, is to create the kind of data which is needed to support the creation and optimization of capital, particularly with a sustainable lens now. And of course, this focus on sustainable finance, I think, as Daniel rightly pointed out, focuses both on risk, looking at risk and integrating it into risk management processes, looks at opportunity, the opportunity to finance the decarbonized economy of the future, and indeed, of course, looking at impact, how a company is really driving impacts on society and the environment. And of course, you need really good data and really good standards, to Daniel's point, in order to be able to do that. And that's a journey which I think we're all on, which the market is on right now. ESG data is, of course, critical to that conversation, but also, as is sustainable financing data on transactions and deals which are being launched on financial markets, which are driving sustainable outcomes. And that's been a very large focus for Refinitiv over the course of the last 9 months. And I'll probably speak about that in a little bit. But certainly, as part of the London Stock Exchange Group now, we've obviously both got market data. We've also got the opportunity to drive how we list companies on the London Stock Exchange and what we require of them in order to be listed companies to be listed on the exchange. And indeed, of course, we've got the benefits of FTSE Russell and driving indices in order to optimize capital at scale en masse around adoption of sustainable indices. So, we think we've got an important role to play to support that creation and optimization of capital that the financial services firms are really driving for. Back to you, Franita.
Thank you, Leon. Great. So I think let's firstly set the scene by outlining what the current state of sustainable finance looks like. And Leon, I'm going to stay with you. Please, can you give us a high-level global overview of sustainable finance today?
Sure. Let me give a very quick attempt to do this. When I took on the role of focusing on sustainable investing for the organization Refinitiv a couple of years ago, relatively shortly after that, I actually met Daniel, who of course is another panelist here. And he and I remember chatting relatively informally. And one of the things that I wanted to achieve and accomplish was to drive a little bit of more clarity into the market as to how much capital is being raised on financial markets, which is sustainable, driving sustainable outcomes. And at the time, really, there was a lot of talk of green bonds and looking at green bonds trends. And that's important because, of course, green bonds are the most mature product in the sustainable financing space. People understand what they are. Beatrice rightly pointed out the importance of ICMA and the ICMA principles around what constitutes a green bond. And certainly we've been tracking those, but I felt that there was much more to sustainable financing than just green bonds. And so we sort of took it upon ourselves to try and define what we thought that broader sustainable financing opportunity looked like. It includes green bonds, but it also includes other deals where use of proceeds are being used to drive green and clean energy outcomes. And also looking at actual companies and what do companies do. If a solar energy company issues a bond or issues a loan or even indeed issues equity, then that is sustainable capital, whether or not all of the use of the proceeds of the bond are being used in a way which is consistent with ICMA principles, simply because of what the company is doing and what its contribution is. And so once you start looking at across all of those different criteria, both the product type and the use of proceeds and the business and the products and services of companies and what they're raising capital for, then you start to get a lot more of a holistic picture around sustainable financing. And you're not limited then just to looking at bonds. You can also look at loans and you can look at equity. You can even look at M&A, which is driving sustainable outcomes. We produce these reports now. And I'm sure that they will mature because the market still needs to mature, and defining what some of these types of deals like transition finance deals are and aren't is still to come. And we're working with partners on what that looks like and with the industry. But certainly what the data tells us is, as Daniel rightly pointed out at the beginning, sustainable financing is larger than ever. Last year was by far the biggest year that we've ever seen. It was the biggest year for environmental financing, green financing that we've ever seen. And of course, it was a massive leap up in terms of social financing, with the focus both on response to the pandemic, as well as actually other important social aspects like Black Lives Matter as well, driving a lot of financing and focus on the S, but not at the expense of the E. So, I think those are some of the kind of core dynamics around what Refinitiv has tried to do to help create a little bit more clarity around this space and being able to look at it through a more objective, data-driven lens.
Thank you, Leon. Daniel, I think this is a good segue into your space, and we would like to hear, where you're seeing the practical opportunity for sustainable finance, following on from what Leon said.
Yeah, thank you. And as Leon said, this is a still very young asset class, but one that is developing quite rapidly. If you look at it, the most visible part of the market is the green bond market, which really was invented 5 years ago when we all agreed the green bond standards, as both Beatrice and Leon pointed out, through the ICMA. But 5 years on, this is now 5% of the global bond market. And I think that's quite a remarkable story. Having said all of this, at the moment, the green bond market is quite narrow. It normally focuses on governments, financial institutions, and a few corporates that are very, very green in their credentials often, that are issuing green. And that is partly because you need to create benchmarks first, and it happens with governments issuing first. We've seen it in the Middle East with sovereigns like Egypt coming to market. But also, it is often a fear from corporates that if they issue green while they're really on a transition journey, that some investors may not like it. And so what I think is happening now is that the well-established market of green bonds is spreading out. And with that, I mean, we see more and more corporates coming to market with transition bonds, sustainability-linked bonds, which really, I think, is a tool for large corporations that are in these transition industries to demonstrate that they have a plan, that they're moving over a decade into more sustainable business models in the end. We see a lot of focus on infrastructure. So there's a big push into establishing common standards for sustainable infrastructure and creating essentially a marketplace for sustainable infrastructure, because we all realize that at the moment we're only mobilizing a fraction of the capital needed, especially in emerging markets. And we see an increased focus on nature. So the importance of investing in nature, of nature becoming an asset class, is well recognized around the world, because to achieve net zero, we need negative emissions. And for that, we need more investments in nature. So I think it's quite nice to see how this whole started with the nucleus of the green bond market is now really spreading out. But if you think about it, the benefits of this market are very, very clear. They provide companies with access to new sources of finance. Very often you bring investors into the game, especially in emerging markets, that normally wouldn't look at that asset class. There's increasing evidence that companies finance at lower conditions, because actually the future risk of an investment is seen as lower. But also, I think it is a great tool for CFOs and treasurers to get a hold of that transformation agenda. Because once you issue a sustainability-linked bond, loan, or a green bond, you have KPIs that you have to monitor, and you report back to the market every year. And that gives investors the trust, but the CFO essentially a toolkit to hold the organization to account. And finally, I think the market has established itself as a great tool to communicate what companies are doing. And back to my earlier point, the main problem that I think many companies have at the moment is the lack of trust. That what they're saying on their websites isn't always translated into action. And these products that we're talking about today are essentially products that enable trust because they publish KPIs, they have use of proceeds behind it, and therefore investors know what they're investing in. And I think that's why the market has seen tremendous growth in that core of green, and is now really spreading out. And we see that in the Middle East, where I think from starting with the sovereigns now into the corporate space, and obviously now a lot of the companies that are in the core of the energy transition are looking into this market for change. We've recently helped Etihad to issue their first transition sukuk, which helps an airline at the scale of Etihad to actually demonstrate to the market that there is a business model that is aligned with the energy transition. I think those are great examples where the Middle East is actually now leading the debate.
Thank you, Daniel. I think you did a great job there at actually outlining also the different roles that the groups play within that workflow. With that, Beatrice, let's turn to you, and can you maybe give us some insight as to the role that the IFC has played in this, the IFC's involvement, and particularly what we're doing in the market.
Thank you, Franita. Yes, IFC last year globally committed over $3 billion on climate transactions, which represents about 30% of its total own account commitments. IFC has integrated climate into its investment operations across 5 main areas, which are clean energy, sustainable cities, climate smart agriculture, green buildings, and green finance. And that demonstrates the range of our expertise. Looking ahead, IFC's new climate business targets are an average of 35% of own account investments between FY financial year 21 and 25, so about 35%. In MENA, in the MENA region, climate finance is not yet as highly developed as in other financial markets. And frankly, we are still quite far from the 35% target that IFC has set for itself. This is due to multiple market challenges. The first, regulatory framework. Second, the financial market development. And third, a perceived lack of climate assets available to be financed. Despite these challenges, over the past 5 years, IFC's own account investments in climate transactions reached almost 1.3 billion in the MENA region. So how does IFC work? Well, we pursue a comprehensive approach. First, we try to support the development of the regulatory framework by working with central banks and capital markets authorities to develop investment opportunities and financial instruments in this space. Second, by investing in sustainable finance projects across the region. And third, by working on the further development of new asset classes, such as renewable energy and energy efficiency. So let me give you an example of how IFC has supported the development of the green bond market here in Egypt, and Daniel already mentioned it. First, in collaboration with the World Bank, our sister organization, IFC started working with the Financial Regulatory Authority in Egypt back in 2016 to provide support to the development of green bond guidelines. Second, the World Bank Group developed or supported the Egyptian government in the issuance of their first $750 million green bond last year. So that's the sovereign that Daniel was talking about. And currently, IFC is providing technical assistance to a commercial institution on their first private green bond issuance. So Egypt is also a participating country in the 30 by 30 zero program. Now the title is a little bit, needs a little bit of explanation, but what this program wants is to increase climate lending through the financial sector. Specifically, by 2030, the share of climate lending in participating banks' total loan portfolio shall reach 30%, while climate and carbon-related risks should be reduced to zero. And finally, through leveraging the sustainable banking network, which we helped to create, we are supporting central banks and regulators in managing climate-related financial risks. I think the two speakers were also talking about the management of climate risk. Then second, we are trying to stimulate the growth of local climate bond markets. And third, this network tries to help banks transition to a greener business model.
Thank you very much for that, Beatrice. I want to turn to the next question, which is around the pandemic. It has been mentioned before now as well, earlier in the session, but I don't think any discussion of this sort is, complete without mentioning the pandemic and at least raising it as a discussion point. So, Leon, from your perspective, how has the pandemic actually changed the sustainable finance scene?
Yeah, I'll offer up a couple of thoughts, and keen to hear thoughts of the other panelists as well. But look, I guess I think of three obvious things that strike me in terms of how the market has sort of evolved, developed in response to the pandemic. The first is perhaps not what most people take away from it, but which I think is very important, is that the pandemic has obviously caused, immense humanitarian crises globally, and that has led to massive economic implications globally, with very, very significant sort of downticks in terms of GDP growth in numerous countries around the world. And yet, the data that we receive indicates that will be something along the lines of 5% carbon reductions globally, that order of magnitude. Now, what does this tell you? It doesn't. I think that some people have taken away the wrong lesson. Interestingly, they've taken away the lesson that somehow, well, that means it's possible to reduce climate change or possible to reduce carbon emissions. I think that's the wrong lesson to take away, because no one wants to live like the way that we have lived over the course of the last year or so, and the massive impact it's had on human livelihood and so on and so forth. And yet, even with all that impact, we can only reach 5% carbon reduction. So carbon reduction has to come through massive mobilization of capital into decarbonized industries and technologies and capabilities, innovation, science and technology, et cetera, et cetera. It can't come just by doing less. So degrowth is not an option here, I think, is the kind of critical takeaway. The second thing that I would highlight is that what the pandemic has brought to a head is the importance of, if you can internalize an externality and quantify it, then you really ought to. Because, of course, if you could have predicted the pandemic and exactly what kind of shape it would have taken, when it would have hit, and what shape it would have taken, how disruptive it would have been, then clearly you would have taken that into your business model if you'd known ahead of time, and you'd have operated accordingly. Now, of course, there are some risks, such as climate change and other ESG related risks, which you can internalize and which we can do quite a good job of quantifying. We're still evolving in that space, but which we can do quite a good job of internalizing and quantifying there, in which case, why would you not do that? And the third thing is, and I mentioned this earlier, is this focus on the S of ESG, which I think was underrepresented before the pandemic, but which, of course, there's been an enormous amount of focus on over the course of the last year. And indeed, there are challenges in quantifying aspects of this social impact and how you internalize and quantify them. But you have to start the journey somewhere. And so I think that it's really forced the hand of both financial players and companies themselves to establish really what are those risks and impacts that they can have on society, and what risk does society have on them, and they can start to do a better job of managing to that. And we've certainly seen a lot of interest in that, and that will evolve quickly over the next few years. There we go. Some thoughts for you. I'm interested to hear what the other panelists have to say.
Thank you, Leon. Time is ticking away, but I would like to just give Daniel and Beatrice the opportunity to comment on that if they do have any other comments.
I'll be very brief. I agree with everything that Leon said. I think for me, the one additional point to make is that in my mind, the main reason why this is such an accelerator for sustainable finance is that for the first time, we have all the relevant stakeholders aligned. Investors, as I said before, realize that it's a source of outperformance. So ESG is seen as an alpha generator, not what it used to be, a governance-y type activity. Second, companies realize that they need to change their business model to attract money, but also to deliver growth. So this is about creating a positive vision for the future. This is not about defending a business model in front of journalists or NGOs. And I think that's really important. The third topic is that regulators, and the third stakeholder is that regulators are pushing on this now. You have about 80 regulators organized now in the NGFS, the Network for Greening the Financial System. And once you have regulators pushing this, you see true change in the boardrooms of large financial institutions. And finally, policymakers, right? Governments around the world, they know they have one shot to unleash growth through fiscal stimulus. There will be no money left in the rest of the decade because we're running out of money. We have one shot for fiscal stimulus, and that's why there's so much focus on building back better green recovery. And so you have now investors, companies, regulators, policymakers, and increasingly the public pushing in the same direction. And that's the way to unleash a topic that we've been debating for the last 10 years, but we never really got it into the mainstream.
Right, thanks, Daniel. Beatrice, from your side?
Yes, just building on what Daniel and Leon have said. I mean, COVID-19 has really highlighted the value of sustainable finance, both to manage ESG risks, but also to unlock capital to build back better. And even as countries battle the COVID-19 pandemic, it is critical that they don't lose sight of their goals to reduce carbon emissions. Rebuilding economies to be greener and more sustainable is not only necessary for paving the way for a more resilient world, it will also support the economic recovery from COVID-19. And finally, you have also mentioned it, a green COVID recovery is a cost-effective way to transition to a low-carbon future because it can also deliver economic growth and the jobs quickly.
Right. Right. Great points there. Thanks, everyone. Our next topic is, and I guess this is where the tires really hit the road, right? Is around productizing sustainable finance. And Daniel, I'm going to give the first question to you. What would be the best way to productize sustainable finance and helping the market mature? What criteria, need to be met in this regard?
I'll be brief. I'll give you three pieces of advice or learnings. The first one is sustainable finance is not an objective in itself, right? It's not an objective to have a large green bond market or a large green loan market. It has to deliver something. So I think first comes the strategy. What kind of money, what kind of projects, what kind of change do we want to facilitate? And that can be at the sovereign level, but also in a company. Just issuing a green bond is nothing that will excite an investor. What excites an investor is if you have a vision for the future and use a green bond to mobilize the capital for it. So strategy comes first. Sustainable finance isn't an objective in itself. Second, you need clear standards for the products and for what you're trying to achieve. So having a sustainability linked loan, having a green bond without a KPI set, without a transition pathway that gets you to net zero, is nothing that will bring investors forward, because investors want to invest into the vision in the long run and want to see the pathway. So before you issue, have a strategy, have a pathway with clear KPIs and product standards. And third, all of this will only come to life with good disclosure and reporting. Because as I said before, one of the big things that is holding back the market is the lack of trust. Because at the moment, when you open any company website or read any press conference statement, everybody is saying the same. So what people are really looking for now is, can you actually prove to me that you're putting your money where your mouth is, that you are moving CapEx into the right direction? And so I think that's my third piece. First, have a strategy. Second, have a clear pathway with clear KPIs that you can demonstrate. And then third, over-communicate, over-report on them to build trust in the system.
Right. Thanks, Daniel. That's certainly very clear. Beatrice, what potential exists in the MENA region for sustainable finance, and how do we ensure the funding gets to the correct user for whom it is actually?
On an IFC report that analyzes the level of bank and capital markets financing required to finance the nationally determined contributions to the international climate agreements, sized that sustainable finance potential at some $23 trillion. That includes some 265 billion for the MENA region. Buildings, transport, renewables, electricity transmission and distribution, industrial energy efficiency and waste management are the target sectors for these investments. Now, in order to channel these required funds to this massive pool of green assets, it is absolutely necessary to pursue a systemic approach and include governments, international financial institutions, commercial banks, and real sector partners. And the second topic in regards to transparency for the use of funds, this has an absolute top priority, and Daniel already mentioned it. In the case of capital markets, this is achieved through the development of regulations for thematic bond issuance, such as the Green Bond Principles, as mentioned already by the International Capital Market Association, or the Climate Bond initiatives. In the case of IFC, we track impact indicators for all our climate transactions. More generally, and outside of capital markets and transactions funded by the international finance institutions, standards from the Task Force on Climate-Related Financial Disclosure are increasingly being adopted, mostly in developed economies. But increased climate financing will also support MENA markets in the adoption of some of these standards or similar standards. And finally, I already mentioned the Sustainable Banking Network, which also plays a vital role in ensuring funding is getting to the correct end user intended.
Leon, any thoughts from your side on productizing sustainable finance?
Yeah, sure. Let me just offer a couple of additional thoughts. I think that Daniel and Beatrice have been very comprehensive, but looking at it through the view of a market data provider, what kind of data is needed to support this space? I think there are probably two things I'd focus on. One is there is an ongoing need for better definitions. I mentioned this very briefly earlier, but how do you define what a transition bond is and isn't? What criteria needs to be met there? Now, I don't think that Refinitiv should be playing a role of defining those. I think that gets defined with the market, but we certainly do engage with industry bodies which are market-led and which have the likes of IFC and indeed HSBC and many other market participants leading those in order to try and really define what those things are. Especially when things like sustainability-linked bonds, which Daniel's made one or two references to. You want to be able to have a degree of normalization across those KPIs so that you can really understand from one company to another and from one deal to another, really, how on track to drive meaningful outcomes are these issuers, and how do you judge whether the bond is worthwhile investing in? And so a look at standards across the actual definition of those sustainable transactions, I think is important, and we certainly play into that, although I don't think it's our role to define that. The second thing is that ESG data typically is very heavy on the operations of a company. Company disclosures are focused on the sort of things that companies can be responsible for, their own carbon emissions, their own diversity inclusion policies, their own operational capabilities. What is less well understood is the impact of the products and services, but often equally as important and sometimes more important. And so I think things like establishing the impact of the revenues of a company, how much OPEX and CAPEX from its own balance sheet is it deploying towards sustainable outcomes, and how do you judge how green the revenues are from a company? It's certainly led by the incoming regulation from the EU taxonomy, I think is a very good start in that direction, and capturing data around the impact of products and services because that gives you a proxy for the business model. How sustainable is the business model of a company in terms of its provision of what it provides to the market, as well as just its operations. And both of those lenses are important to have a holistic view around how sustainable a company is. And the data needs associated with that are obviously increasing, and we're playing a very important role in. So, you know, a couple of additional thoughts there just from a data perspective.
Thank you very much, Leon. We've got about 10 minutes left, so I quickly just want to check whether we've got any questions. No questions yet. So I would like to remind the audience to please post your questions, either using the app or the website, and we can get those answered for you. Right, Daniel, I think you said it very well, where you basically said nature is also important now, or that's coming to the fore. So I think with this question, I'd like to focus specifically on the E in ESG. And Beatrice, I'd like to first start with you on this question. So the IFC, you know, has been instrumental in creating markets for green bonds in emerging nations. Could you please share with the audience your specific experience in the MENA region and how these markets have progressed up to now? And also, the green economy is seen as a source of employment, right? Critical in emerging markets specifically. So please also share your views and experiences in this regard.
Thank you, Franita. Yes, IFC has played a foundational role in the development of the green bond market in four main ways. First, as an issuer, IFC is a pioneer in the green bond market and it is one of the largest global issuers of green bonds. All in all, it has issued 172 green bonds in 20 different currencies for an amount of about $10.4 billion US. Second, IFC has acted as an investor. Over the last 5 years, IFC helped 20 financial intermediaries and one utility to issue bonds in the emerging markets. These investments in green bonds represent an expected greenhouse gas reduction impact of 3.2 million tons CO2 per annum. IFC has also set up the world's largest green bond fund to support green bonds issued by banks active in emerging markets. And it has supported in the MENA region some of the first green transactions. One was the first green bond in a foreign currency in Morocco. Another one was the first green bond in the Levant, in Lebanon. Third, it also IFC supports the market development by providing technical assistance to regulators. It has leveraged its experience as an issuer and investor in green bonds, and as a member of the executive committee of the Green Bond Principles to support market regulators. It has helped a number of countries starting in the MENA region, starting from Morocco, Egypt, Tunisia, Lebanon, and Jordan, already back in 2016 by providing support to these countries' regulators. And the fourth one is to support the issuers with technical assistance or advisory services. For example, it has offered support on thematic bond issuance, also in line with the principles of the International Capital Markets Association, and it has partnered with financial institutions, usually for their first thematic bond issue. Now, your second question, which is like, is the green economy also a source of employment, which is a particularly important topic to emerging markets? Yes, absolutely. The green industries have a track record of generating jobs quickly and are projected to grow due to declining technology costs and also due to increased demand. Global estimates show that every 1 million spent on renewable energy creates between 7 and 15 full-time jobs versus 2.7 jobs related to fossil fuel. So there seems to be an opportunity there. Based on a recent study by AFE, the potential investment opportunities in the MENA region over a 10-year period from 2020 to 2030 are estimated to reach more than 200 billion of investment opportunities with 4.2 million new direct jobs. So there is a job creation effect there. In addition to job creation, developing green economies is crucial, as we believe that without climate action, the world is likely to face severe financial impacts, including increased credit risk, unemployment, and stress on insurers. So the severe economic disruption caused by COVID-19 could be considered a mirror to the disruption expected from climate change. So I leave it at that. Thank you.
Thanks, Beatrice. Leon, one of the things that, or the examples that Beatrice used, the fossil fuel companies, I think it would be interesting to get your thoughts on the currently depends heavily on fossil fuels, we're all aware. Do you see this as a risk or an opportunity as these companies are expected to move to low carbon energy sources?
I suspect that you know that my answer is it's not binary. It's both of those things. It's both a risk and an opportunity. But it is an important point, and I'm pleased that you've raised it because, of course, you know, a number of economies in the MENA region are very heavily dependent on fossil fuels for driving their economy. And of course, that does mean that there is potential risk associated with the decarbonisation of the economy that we want to reach, as well as the opportunity, which I think Beatrice just delightfully described, you know, what that looked like and the opportunity for job creation there. I think one of the things that I've sort of said in the past, and I don't want to confuse myself as a MENA expert by, you know, any stretch of the imagination. So instead, if we focus on those companies which are energy companies which are heavily dependent on fossil fuels today, a number of companies are starting, more and more are following suit in terms of making commitments towards a net zero future and identifying themselves as being able to be in a position to be net zero by 2050 or indeed whenever it might be that they're setting themselves those targets. Now, that is incredibly non-trivial to do. If they're going to achieve those, and we have to establish how credible those targets are, if they're going to achieve those, that's incredibly non-trivial. It means a total transformation of those businesses, you know, top to bottom. And typically companies don't go through that level of transformation and wouldn't commit to that kind of transformation, which carries with it by definition lots of risk as well as lots of opportunity, unless the risk of not doing so was much, much higher. And indeed, the risk of not doing so is so significant of not figuring out what your role is in a decarbonized economy, in an economy which will effectively, you know, punish you for being highly carbon intensive and for being in highly carbon intensive industries, in which the cost of capital is going to increase dramatically, in which investors are not interested in investing in those companies anymore, in which consumer pressures are forcing companies away from that type of business model. All of those pressures will continue to increase over the course of the next few years, and will become very, very meaningful. And indeed, the regulatory pressures will start to apply as well, especially with a potentially more mature carbon pricing market. So the risk of not figuring out your decarbonisation strategy starts to become extraordinarily tangible. And so, yes, there is risk and opportunity associated with setting yourself a net zero target as a company which is heavily fossil fuel dependent today. But the risk of not doing so, I suggest, is actually even higher.
Right. Thank you, Leon. Lastly, Daniel, this is our last question, and we're staying with the fossil fuel topic. So for a region that is so dependent on fossil fuels, what does the transition look like to go from a high carbon industry to a low carbon industry?
Yeah, I know we're almost out of time, so let me just offer a few quick thoughts. First of all, nobody expects that this happens overnight, right? This is a decade-long transition. Second, we will not achieve net zero if we just change energy supply. We have to change energy supply and demand. And therefore, I think working on both sides is so important, working with customers, working with the end consumer. Otherwise, we will no longer be generating or getting oil out of the ground, but everybody is still driving a car and will have a problem. Third, I very strongly believe that we will only achieve the energy transition if the largest companies in the world invest, because they have the firepower, they have the cash flow. We will not do this with startups, not just with startups. And therefore, I think it is absolutely key that the large companies in the world see this as an opportunity. And Leon and Beatrice said it very clearly. It's to diversify revenue streams, manage future risk, create growth and create jobs, which is so important. And finally, I think the Middle East has a few really interesting opportunities when you think about renewables, hydrogen, but also when you think about the future of cities, the future of smart cities, where everybody is now looking at role models. In the Middle East, we have the smartest cities in the world. And finally, I think it's really interesting to think about the energy transition as a way to leapfrog, build new industries, build industries of the future. And I think in the Middle East, we have a great opportunity because a lot of governments have been very forward thinking for a while. And we essentially can write the industrial roadmap for the future. So again, I can only echo, this is as much an opportunity as a risk. It will take decades, but I think it's important that the large companies and the large governments in the world are actually leading that transition. Sustainable finance is the mean to achieve a lot of this. It's not the objective in itself, but you can see from our discussion today, there's so much investor appetite for this, but the investor appetite is looking for opportunities they can support. With that, thank you from my side. Thank you for having me.
Wonderful. Thank you very much, Daniel. I'd like to thank all the panelists for sharing your knowledge and your insights and participating in today's very interesting conversation and panel. Thank you, Daniel. Thank you, Leon. Thank you, Beatrice. I believe there is a video which is going to be shown now. So I'd like to ask the panelists to just turn off their microphones and their videos, and then we will be able to watch that, the audience. Thank you, everyone, for joining.